Hello, this is Tom Vassallo with MRW Financial Brokerage, and thank you for taking the time to learn more about our long-term care planning toolkit and how it can help you enhance your practice with your clients. This is Module 3 of the training platform, specifically about the long-term care planning meeting. So hopefully at this point you've had the discovery meeting and used the long-term care planning guide with your client. You completed that questionnaire, got it over to us at MRW Financial, and we created the long-term care planning summary for your client. And this summary equips an advisor with a clear client-ready report that compares multiple long-term care illustrations from top carriers. In this case right now it's Nationwide and One America. As better products become available, we may swap them out, but currently it's Nationwide and One America. And it highlights the leverage of proactive planning, and it helps a client visualize their best options. It also helps streamline complex data, multiple illustrations into one simple and persuasive tool that helps you build trust and drives confident decisions by your clients. Now, this is what the long-term care planning summary looks like. And each one of these are custom prepared based on the fact finder that you completed with your client discovery meeting. And you're going to receive 3 of these. We always base the comparison on what their cost of care will be at their age 80. And if it's a husband and wife, it's their joint equal age of 80. Because with Nationwide, you'll see the inflation rider makes a lot of sense. With One America, it doesn't. So that way we equalize the benefits at their joint equal age of 80. Now, whether you have an individual or a married couple, the flow of this is the same, and I'm going to show you for a couple, for a husband and wife, how it works. But the flow and the way you use this long-term care planning summary is the same for an individual. Now, at the very beginning, we're going to reinforce the reasons that you develop a proactive long-term care. And you're going to notice on here these different videos. If it is a PDF version, your client, or you can click in, it'll play the video. If you print this out and deliver it to them, you can take your phone or your tablet, scan the QR code, and it'll play the same video. Now, there's reasons you want to play the videos, and I'm going to discuss each reason, and based on your interaction with your client, why you would play the video. For example, many times the long-term care conversation is driven by the wife. They realize their husband's probably going to predecease them. They're probably going to be the primary caregiver for the wife. And a lot of times I've seen the husband being dragged into these conversations. And if you get the feeling, and first of all, you have to have the meetings with husband and wife there. Your hands are really tied behind your back if the husband's saying, well, explain it to me, and then I'll explain it to my wife. You have to do everything in your power to get both husband and wife there. Now, let's assume in the discovery meeting and just in the conversations, you've realized the wife's the one that really wants this, the husband isn't really interested in it. Then you want to click this video and play it for them. Because what this video is, and I'm not going to play all of the videos, there's 1 or 2 I'm going to play, but I'm not going to play all of them. But what this spouse's video is it's a emotional video from a wife's point of view. It's a spouse telling it about what it was like for her husband to get sick. She started providing the initial care. Things got worse. She's getting money go out the door. She's wondering how she can pay her bills. She's just completely overwhelmed with it. And then, it foreshadows into, I'm so glad I did a long-term care plan. It helped me with this, and it gets sunnier because of the long-term care plan. And it really is going to help make those emotional connections and either open the husband's eyes on why long-term care is important, or empower the wife to convince the husband that long-term care planning is important. The next video has to do with adult children. And if you get the feeling that they believe their children are going to take care of them, or you have a child in there that's being resistant, don't spend the money, mom or dad, I'll take care of you. This one is told from an adult daughter's point of view. And it shows the wear and the burden on the daughter that she's happy to accept, but what it means to her in life to have to take care of her parents while she's raising her children, and she's probably working a job. So what it's going to do is if the parents really believe their children are going to be there to take care of them, click and play this video so they understand the burden that they're placing on their children. In addition, if they have multiple children, how long-term care can potentially fracture family relationships, because the burden never falls equally on one child. Now, this isn't told from a children's point of view, it's told from a narrative point of view. Another situation is, and this one wouldn't be for the ultra wealthy, but for those that can possibly afford long-term care, but it would really be detrimental to a healthy spouse. This is told from the wife's point of view. The wife tells the story of what it means that her husband needs care. She's just seeing her finances drain, and her retirement security is really going into jeopardy, and she's thinking about selling the house, things like that. So again, it helps drive home that point. By the way, between the spouses and the retirement income, one of the things we hear a lot of times is the husband saying, and it's with good intentions, but the husband saying, I want to make sure my wife's taken care of. Let's get a policy on her. Let's not, but I don't need a policy because I have my Smith & Wesson. Well, that's like saying, I want to make sure my wife's taken care of, so let's get life insurance on her. If he really wants to take care of his wife, he needs to get a policy on himself. And playing that spouse's video or that retirement income video is going to drive that point home. Also, if their personal experience with long-term care is a short-term claim or a short-term loss, play this video on the length of care and how long-term care, you really don't know how long it's going to last once it starts. On the next page, many times people will say, I haven't had an experience with long-term care. My parents didn't need long-term care. But as you're talking to them, many times they've already outlived their parents. So there's a discussion here on how life expectancy has increased substantially. Between 1800 and 2017, it's nearly doubled. And because of that, we're living longer, but we're living longer with more age-related conditions that require extended care. So simply looking at your parents and whether or not they needed care and whether or not you went through it may not be enough. It is also talks about the rise of cognitive issues as life expectancy has increased, and Alzheimer's disease and senility, and how those really lead to the long claims. And for those individuals that just think they're not going to be the one that needs care, if it's a married couple, there's a 91% chance that one or both of them will need care. This will help drive home the likelihood of needing care. Now, on the next page, there is one video I would absolutely show, and I want to play this video for you just so you can sort of see the quality of the videos, and that is the consequences of converting assets to cash flow. Because in order for this conversation to be compelling for them, they have to fully understand long-term care is not, I repeat, not an asset problem solved with assets. Long-term care is a cash flow problem that we solve with cash flow. What we're trying to do in this case for this couple is meet the average monthly long-term care costs. And you'll see here, this cell in red, their joint age of 80, the blended care of $13,636 per month. So today in 2025, by the way, that blended care is simply the average of informal, home health, assisted living, and nursing home. And we're assuming they're going to move slowly through all levels of care. We compound that at 3% to their joint age of 80. And that's how we came up with the $13,636 per month. And you're going to get three versions of this report. One where we are matching the monthly benefit to 100% of that $13,636 or 100% of that projected amount. another one where we're matching it to 75% of that projected amount, and a third one where we're matching it to 50% of that projected amount. Up to these pages, the reports are going to look exactly the same. It's just when we're showing the product solutions, we're cutting the premium and the benefits by 75% or 50%, depending upon which report you're opening with. I'm not a big believer in insuring 100% of the risk. I believe everyone can afford to self-fund some of the risk. And the goal of these reports is to narrow down which product they're interested in, what payment terms they're interested in, and how much they want to self-fund the risk. Everyone says long-term care is expensive. Well, yes and no. Yes, it's expensive if you're trying to insure 100% of the risk. If you're trying to insure, say, 50% of the risk, it's not quite as expensive. I have clients on claim today for policies I sold them 30 years ago that are getting $2,000 a month in benefit. Back then, the average cost of care was $3,000 a month, and they didn't want to buy inflation protection. And hindsight's always 20/20. Yes, they wish with that crystal ball, now that they're on claim, they would have bought a bigger policy. But not one of them's upset they're getting that $2,000 a month. So my point is that some coverage is better than no coverage at all. So I'm going to go ahead and play this consequences of converting assets to cash flow video and take a look at it real quick. Now we have one of the one-pagers that's in one of the other training models that really delves into this concept deeper and what the consequences are of converting assets to cash flow. Now, when you filled out the long-term care planning questionnaire, you indicated to me which area of the country they'll probably receive care. In this case, it was Northport, Bradenton, and Sarasota. Let's say all of a sudden they said, well, what if we move to our kid's house in Arkansas? Well, you can click on this link below or scan this QR code and you can find the average costs for any state, any metropolitan statistical area within that state. And the premiums and the benefits move linear. In other words, if that state is cheaper and it's 70% of the rate of Sarasota, the one we display here, then the premiums will be 70% as well. Make sense? Okay, when we talk about long-term care planning, and this is where it starts getting custom for your different clients. We're talking about planning. The core concept of every plan is to create leverage. In other words, we want to get $1 to do the work of $3, $4, or $10 if we can. So this is the first step in illustrating that, and this is why we have to convince them long-term care is a cash flow problem and not an asset problem. If you remember, their blended cost at their joint age of 80 was $13,636 a month. So what happens if all of a sudden we're age 80, I need care, and we have to start spending $13,636 a month more? Where is that money going to come from? Now, in the discovery meeting with the long-term care planning guide, I showed you how to determine, what are they going to first? Is it going to be tax qualified funds, non-qualified funds, cash that they have? And hopefully you remembered that so you could short circuit this. But let's say they said it was their IRAs. Maybe they're retired school teachers and most of their assets came from their drop money in Florida and it's their 403B. So they're going to have to withdraw the money out of their IRA. Well, if they want $13,636 to spend per month, they're going to have to actually withdraw out of their tax qualified funds $19,480, pay $4,313 in taxes to net out that $13,636. If it's a non-qualified fund, they're going to have to pay capital gains tax on the growth. So they're going to have to liquidate shares, liquidate homes, and to get $16,042, that is what they'll have to liquidate, pay $2,406, and it gets them $13,636. Let's say they had an emergency fund, CDs, a money market. Well, the taxes are already paid on that, but they're still going to have to withdraw dollar for dollar. They're going to have to withdraw $13,636. Well, the goal of a plan, the goal of a long-term care plan is to use tax-free funds and get up to a 75% discount. So let's look at this. And the first option I always show is the full liquidity option. This is One America's asset care plan. It is sold with the return of premium rider. And this is an example of the illustration here, and the illustration is included for you, but it's their asset care with return of premium. And the premium that goes in of $220,697, and when you go back to the illustration, you can see that premium of $220,697. And for that $220,697, we are covering 100% of the projected monthly amount. Now, if you open the 50% illustration or the 75% illustration, you'll see these numbers adjust accordingly. Because again, I'm not a big believer of everyone insuring 100%. But when the parents go on claim and I'm dealing with the children, I want to be able to show them, well, here's where I showed them 100%. They decided to insure 75% and self-fund 25%. As you can see, that's a monthly benefit of $13,636. That's that same red number that was on the other page showing the cost of care. Now I'm showing you where these are in the illustrations, but I'm not taking out the illustrations with the clients to explain this. I'm just going through this long-term care planning summary. But on the illustration, you'll see that it's got a monthly benefit of $13,636 per person. If they're both on claim at the same time, it'd pay a joint benefit of $27,272 a month. And it provides a total combined pool of money of $981,792. And you can see that here, $981,792. That would fund one person on claim for a period of 72 months or 6 years. Now, if they were both on claim at the same time and it started at the same time, they'd each have a 3-year benefit, because it's really the $981,000 that is taking it down. But that is a benefit period, 2 years of AOB, or the acceleration of the death benefit, acceleration of benefits. So if you took the face amount, the death benefit of $327,264, and divided that by 24, that's how we come up with the $13,636 a month. Once the death benefit is exhausted, there's an additional 4 years of continuation of benefits. But here's how I like to explain it to a client. Imagine you have a $981,000 joint pool or joint checking account. You can each withdraw up to $13,636 a month, but you're drawing off the same joint checking account. And when that $981,000 is gone, the policy is paid up. By the way, notice this is a male and female age 60. Let's assume we pass away and don't need care. All right, we've put $220,697 in. My children are getting $327,264. This is a joint second to die policy. Here's where the death benefit is on the illustration, $327,000. Now, this is the key part of this one, the full liquidity option. They put in $220,697, but this is what you have to get across to them. You are not spending that money. You're simply moving it from your left pocket, maybe a CD, a money market fund, because it's your emergency fund, to your right pocket into this asset-based long-term care policy on a joint second to die whole life chassis. At any time, I don't care if it's 10 days, 30 days, 6 months, 1 year, 5 years, 10 years later, at any time, you can get your $220,697 back. You can cash in the policies, they give me back all of my premium. So what is this costing you? And you have to get this across to the client. It's not costing you $220,697. Yes, there's an opportunity cost. It's costing you the interest you would earn on the $220,000. If you pass away and never need long-term care, your kids are getting $327,000, so that's more than $100,000 more. But if you need it for long-term care, it has a $981,000 death benefit. And you'll see this on the illustration page. All of these numbers are guaranteed. This is the guaranteed cash surrender value, and at all times it's $220,697. Yes, it does start to go up after the 22nd year, but I don't even bring that up. It's just a guaranteed return of premium. Now, what is this $220,697 doing for us? One, it's staying completely liquid, so it's not really costing us that. It's costing us the interest we would have earned on it. And we're turning it into $981,792 for long-term care. Now, this is all about creating leverage, so let's think about this. If we have $220,697 in premium, essentially that's for every dollar we put in, it's doing the work of $4.49 to equal $981,792. So that's where we're talking about that 75% discount earlier. Now let's look at this for the tax qualified plans. On the tax qualified plans, if we wanted to withdraw $981,792 to pay for long-term care, we'd actually have to liquidate $1,402,560, pay taxes on $420,000 to end up with $981,000. If we were using non-qualified funds, it'd just be the capital gains tax. So we'd have to withdraw $1,155,000, have $173,000 of capital gains tax, which, by the way, if we would have held those assets until we passed away, has a free step up in basis, and our children completely avoid that capital gains tax to get that $981,000 of long-term care benefit. We would have to grow that $220,000 that's inside our money market, our CD, our cash assets to $981,000 for it to pay out $981,792 and pay taxes along the way. What we're doing with this policy, while the money stays completely liquid, is we're taking that $220,697 and turning it into $981,792 for long-term care. Make sense? Now, I always like to start with the full liquidity option, and that's because it disarms the client. What do I mean by that? It will, in their mind, they aren't spending the money because they can get it back at any time. But this should really be money that they're setting aside that they aren't going to need for retirement, but for long-term care. Otherwise, it's going on as a tax-free death benefit to their children. Two reasons I bring that up. One, because they shouldn't be putting money in there that they need to consume in retirement. You can't leverage it from long-term care if you have to spend it on your electric bill. The other reason is there is a chargeback if they cash it in. 100% of commissions in the first year, 50% in the second year. So you don't want them putting that money in and then cashing it out 6 months later. Because of that, we show two other options that I'm actually personally I like better because it creates more leverage, but I truly believe that full liquidity option is a great option, and if that's what the client wants, it's certainly better than nothing. This is Nationwide's Care Matters Together product, and we're calling it Maximum Leverage product, and you'll see why when we do that analysis. But this is the Care Matters Together product. It's, again, a joint and survivorship life policy. And the single pay is $233,482. Now, when you look at the illustration, it doesn't have a full return of premium. I'd say the cash value is probably going to be about half of that. What's nice about this product, though, is you don't have to do the single pay of $233,481. You have different ways to fund it. Your client can, for lack of a better term, because it's not really financing, but finance it over 5 years at a rate of $50,053 a year for 5 years, and then it's paid up. 10 years at a rate of $28,143 a year. A 20 pay at $18,318, or a pay to age 100 of the older insured of $15,898. And one of the questions people always ask is, what if I go on claim while I'm still paying the premium? Well, the benefits are completely vested from day one, and there is a joint waiver of premium. So if you're on claim when premiums are due, those premiums are waived. Now, what we matched here is 100% of that projected cost. With Nationwide, their inflation protection really makes sense. So in that case, we're starting off with a monthly benefit of $7,550 that's going to grow to that same $13,636 at our joint age of 80 when we most likely need the care. Now, our joint pool of money is $805,000 in this case, and at our joint age of 80, it grows to $1,455,000. That's actually, and you can see it here on this page as well as the ledger page of the illustration, but that's actually 96 months or an 8-year benefit period. But once again, you have to look at it as a joint checking account with $1,455,000 in there. Now, our death benefit is $271,800. And again, that's a second to die death benefit. So if we put this premium in, we pass away, never need care, our family still gets $271,000. If we put it in and we pay out $100,000 of long-term care benefit, our families get $171,000. Any long-term care claims are going to reduce the death benefit in all of these policies dollar for dollar. Now, one of the great advantages of this product is it is paid on a cash indemnity benefit, but look, we're taking that $233,482 of a single premium and turning it into $1,455,000 at their joint age of 80. We'd have to liquidate. The reason we call this maximum leverage is if we take that $233,000 of premium, essentially for every dollar of premium we're putting it in, instead of getting, I think it was $4.41 with One America, we're getting $6.23 of leverage to get it up to $1,455,000 of long-term care benefit. And once again, if we relate this back to how they were going to fund long-term care, if it was their tax qualified plans, they'd have to liquidate over $2 million to get that same $1.4 million of non-qualified funds, $1.7 million. If it was cash assets, $1,455,000. We're creating leverage by accomplishing this for just $233,000. If they don't need it for long-term care, it still goes on to their family in the form of a $271,800 death benefit. Make sense? Now, the last option that I always show is an unlimited lifetime benefit with One America. People that will like this option are people that have experienced long claims with family members. Those are usually your cognitive impairments, your Alzheimer's disease, senility, things like that, chronic progressive conditions that develop and happen over many, many years. I personally have a client that's been on claim for over 18 years now. So this is, again, One America. This is their asset care plan. It's the same plan, just without the return of premium rider. And you'll see the premium is higher than the other two. It's $268,000. Some people that have experienced those long claims want that lifetime benefit period. They want to make sure they can never exhaust the benefits. They're willing to pay a little bit more premium. And you'll see it here on the illustration of $268,000. They have different payment options as well. You see that on page 9 of the illustration. With One America, they have a 5-pay option, a 10-pay option, 20-pay option, and a pay to 95 of the older insured option. Now, once again, this illustration, this summary that I'm reviewing is projecting 100% of the monthly cost. I also provide you one that's 75% and 50%. So that's a monthly benefit per person of $13,636. You can see that there on the illustration. And it's an unlimited lifetime benefit period, so it can never be exhausted. And you'll see that there, that the continuation of benefits is unlimited, and it is a lifetime COB. If they don't need it for long-term care, still pays that tax-free death benefit of $327,264. And again, that is spent down for every dollar of long-term care benefits that are paid. It reduces the death benefit dollar for dollar. Now, I can't do that same analysis, unfortunately, on how much would you have to liquidate from your IRA or your capitally appreciated assets or your cash assets, because this is literally a lifetime benefit. So instead, we put together the largest claims that are still being paid through December of 2018. Broken up by males and females. And you can see these 14-year claims, 15-year claims, 19, 16-year claims. Now, again, there's not a right or wrong answer. When we're looking at long-term care, the juice, the benefits, right, has to be worth the squeeze. What's the squeeze? The squeeze is the premiums. That's why we are giving you several options. 100% of the projected cost, 75% of the projected cost, and 50% of the projected cost. Now, I'm not sure what's going to be most palatable to your client. It may be that full return of premium where they're simply moving money from their left pocket to the right pocket, 4Xing it for long-term care. And if they don't need long-term care, they can cash it in at any time. And what's it really costing them? Well, it's just really their opportunity cost. What would they have earned on their emergency fund over that time? Is it a 3% interest rate, 4% interest rate? You can quantify how much that is costing them. They may choose they like the nationwide benefit. That has a pure cash indemnity benefit, and it's a combined 8-year benefit for the joint policy on the married couple. By the way, if it's an individual couple, or if it's an individual, the nationwide benefit is 6 years. For the Care Matters Together, it's a joint benefit of 8 years. Or they may want the Cadillac plan, for lack of a better term, with the unlimited lifetime benefit period. But this gives you the opportunity to go back and forth and determine which plan they like, determine what benefit level they like, determine what payment period. Would they rather pay a single pay, 5 pay, 10 pay, 20 pay to 95? What's more attractive to them? Then we can run the 1 or 2 illustrations that they're interested in and not flood them with a ton of different illustrations that they're never going to look at. So, excuse me. So that is the goal of this planning meeting. The goal of this planning meeting is to present the idea, present actual numbers, but try and narrow them down. Do you want to insure 100%, 75%, or 50%? It can be any amount. That's just a starting point. They may come back and say, well, I'd like to see what $100,000 in premium would do. We can solve it that way as well. Or they may say, I feel good with a $5,000 a month benefit. Whatever it is, we can, run the benefit level within policy minimums and maximums, of course. You also want to try and narrow down which plan do you like the best. The single pay full liquidity option, where you're literally just moving money from the left pocket to the right pocket. The nationwide benefit, where you have everything from a single payout to a pay to age 100. Or the unlimited lifetime benefit with One America, where you have everything from a single payout to a pay to age 95. So which plan do you want? And then what payment terms do you want? What I typically see is people that are still working. Maybe you want to do a 10 pay, a 5 pay, a 20 pay. They want to pay for as many years as they're going to continue to work and not carry that expense into retirement. For people that are retired, it really depends how they're retired. Some people that are retired on assets don't like expenses. They'd rather move money, and what I mean by that is annual premiums. They'd rather move money from their left pocket to the right pocket in a single premium and be done with it. And like I said, with the full liquidity option, the money can stay fully liquid. Other people, my parents are retired school teachers. They have a pension, they have Social Security. And their pension is a guaranteed lifetime increasing pension. They don't have a problem with an additional monthly bill. And they may want to do a pay to age 95 or a pay to age 100 premium. There's not a right or wrong answer. We don't have a crystal ball to determine which is the best policy. But I firmly believe if you show these 3 options, the full liquidity, the maximum leverage, and the lifetime benefit period, you're covering all of your bases. And you're not going to have someone come in behind you and provide a more compelling solution. Thank you for your time. Once again, my name is Tom Vasallo with MRW Financial Brokerage. At the bottom of, on this page, there should be a link to my calendar. You can book a Zoom meeting and we can do some one-on-one coaching and, answer any questions that you may have, or just give me a call at 813-875-6331. Thank you so much for your time and have a great day.